And everyone, welcome to another edition, the year-end edition, the New Year's Eve edition of Your Money Radio. Let's see here, Tim Razor, Dan. So I'm saying you let's see here, like even though I know it's Danny, who by the way looks like a middle-aged Colonel Sanders. I know it's Hunter. I know it's Hunter. I know it's Don. And you look like a younger Colonel Sanders before he got into the white. Can you show up next week in a white suit? Do you got a white suit?
I do not have a white suit, Tim. Sorry.
It'd be so awesome, man. Every week you just show up in a different outfit.
None of the above.
Well, or maybe, how does the most interesting man in the world dress? Could you like just come in every week as dressed as a different character that has a goat?
I was actually looking for a little New Year's Eve hat, but I didn't have one. So.
Oh, well, I don't know what character that would be, but like famous people with goatees. I said let's see because the interface for GoToMeeting, which we use to record these shows, there's no editing to the show. It's literally a GoToMeeting that we do one take with every time. That's why it's authentic, and it's why it feels very real to you at home. And they changed the whole interface, and so I feel like I'm asses and elbows, if that's a phrase anybody's familiar with, trying to operate the mechanics of the show. And then Danny shows up looking like Colonel Sanders, which threw my whole game off. But what are other famous people with goatees? Abe Lincoln?
Well,
was Abe Lincoln's a goatee?
I think he was a beard.
That's
Maybe
a beard?
not. I think I've been called Jim Rome on this show actually recently with my goatee.
Yeah, we've got I got Colonel Sanders. Danny could come dressed as Jim Rome. How about Captain Morgan? What's Captain Morgan got going on? Is that a goatee?
It's kind of a good, yeah. Colonel Custer. Custer's last stand. Custer's last stand.
I thought you were about to say Colonel Mustard from the Clue game, and I'm like, well, what the hell does he look like?
In the parlor with the knife.
Right here on the bottom. That's why it's not, you know.
Danny, Don, you got any famous goatees that I can't think of anymore?
Not really.
And I haven't seen Danny. Like we talk on the phone every day, but I haven't seen Danny since the last time we did a podcast, and that's a lot fuller than the last time we did a podcast, Danny.
Yeah, it grows pretty fast.
So look, I got a surprise for the fellas here today. So let me show you this, guys. Is it up? No, let me pull it up. Can you see what's on my screen here? It says 181, 2 hours, 6 minutes, 0 seconds, and an average time 10 minutes and 20. Can you guys see that?
I can.
Okay, so this isn't shtick. The fellas actually haven't seen this, and I purposely haven't shared it. So this is on your screen, fellas. This is 2019's viewership, and this translates into 4,300.
2019 or 2020?
Nope, 2019.
2019.
This translates into 4,346 hours of viewership time. So stock nerds and market lovers across the globe in 2019, last year, spent 4,350 in terms of hours with us. Is everybody on the page with me?
Yep.
Pretty straightforward. And that last year was a record for us, right? And so then I'll show you this year. So this here, let me move it, is below here is 2020. And you can see that look at that number. That's 452 days, 21 hours, 53 minutes, 47 seconds. Average view time is up over 4 minutes. And what this translates into is, and I had to write it here, had to write it down in my notebook. It's 10,869 hours. That's how many hours stock nerds and market lovers spent with us in 2020.
That's pretty cool, man.
That is phenomenal growth for a shop that we don't advertise. Like, you only find our videos by word of mouth. Or Twitter. If Twitter is 21st century word of mouth. Danny, do you post any of these to Facebook?
Yeah, we've got a Facebook page, but
But yeah, like it's not, well, we're not running ads against it. It's just,
I'm
you're
not
just,
doing it.
yeah.
I'm just trying to keep an anthology of all of our
Mhm.
stuff, just to keep a record
And-
somewhere other than our website. So,
And this number here does not include the hours that people have spent watching Don's classes, which are tabulated via YouTube. This here is just all the main video views, like anything that we ever post that goes under Daily Market Insight at Revere Asset. That's all those video views. That is what I would call StockNerds tremendous growth, and it's a thank you to you at home or wherever you're listening and watching us. It doesn't, by the way, Danny, this doesn't include podcasts, like the podcast, which is just audio. This literally is just all video views, and it's astounding. Like that is leapfrogging growth, and the pickup in time watched isn't like a lot of people might go, well, that's probably the first half of the year when it was that big sell-off and the people didn't know where market. No. A lot of that has come through in the second half of the year, and so that is absolutely something that stock nerds and market lovers, we are grateful for, because believe me, this is not my mother watching all these videos. So this is you at home watching, studying, engaging with us, asking questions. And I wanted to show you guys that. I wanted to say thank you to the stock nerds and market lovers, because it's a big honking deal. So now, Danny, the number to beat.
I'd also like to thank you guys, because that's also a testament to how much research and free educational material you guys pump out.
That's
valuable people wouldn't watch.
Yeah, that is a point. But in terms of the business model to which we operate here, Stock Nerds, and we don't make a secret about it, we pretty much give away we give everything away for free. If you want us to execute the strategies to which we espouse in these videos, yeah, we're more than happy to tell you how we do that, how it's a DocuSign form away, and how we'd love for you to join the family. But we give everything away that we possibly can for free, simply because we want to empower you. And we know that if we empower you, you'll want to learn more, you'll want to do more. You'll actually realize that most of our clients, if they're not active in the markets, they're actively watching the markets. They have a thirst for knowledge. Like this isn't it can be, if you want it to be you're too busy and you want us to help you, or it can be something that you're very involved and you're engaging with us via via Twitter, or via email, or the phone, 855-732-5932. Did I say, is that the right number? Gosh, Danny, I'm sorry.
It's real easy if you do 855 real wealth, because you can remember.
Well, there you go. I say the number so often. Did I get it right? Yeah, 5932. It didn't feel right coming out of my mouth there. That didn't
By the way,
good.
one other fact, you were kind of making fun of my goatee a little bit.
I was not making fun. I was complimenting you.
I don't know what you call that, but little thing going on the top of your head. You shave the sides and you got a little swirl.
No. Let me tell you something. Tanya made this comment too. And I said, I have never had a better hair day. I have not had a better hair day than I'm having right now. No, absolutely not. And Reagan, actually, the other day, she goes, what's going on with the hair? And I said, you mean how luxurious it is? How I condition and it looks like this? I said, absolutely. Yeah, Pompadour-esque.
There you go. Looks like you went to a hair salon, Tim. You kind of moved up from the barber to the salon.
No, I will never not go to our barber. Danny and I go to the same barber shop. It's Lucky's on Preston. That shop, I love that shop. So yeah. I wanted to get one for Christmas, and then I got too busy and I forgot. So I went.
So you just had them cut the sides, and then you.
They forgot
that is true. I said, make it look like it's still growing. So yeah, absolutely. Leave it thicker on. And I think that because she used to cut it shorter, and I had this thought that I wonder if, because I remember when COVID first hit, Danny, I didn't go to the barber for like 4 months, and then I wonder, and Christine's awesome, and I said, I wanted to ask Christine if she was leaving it longer on top so I come back sooner.
Yeah, that haircut there, you'll need another one in a week the way you like it.
That's what I thought. Well, I don't mind. So she's awesome.
By the way,
Anyways,
before I forget, I would like to say the reason I'm a little bit rough today, didn't really get to comb my hair. I got a phone call at 5 this morning. My niece, Sarah, she's up here in Dallas. She's pregnant. They asked me to be on standby because they got a 3-year-old. And if they go into labor, could I come get their 3-year-old and watch until her mom, my sister-in-law, could drive up here from Bernie, by San Antonio. Well, I get a phone call at 5 this morning. She's about a week and a half early. So, Sarah, good luck. And so I got up, I got woken up pretty early, and I had to just go straight out the door and come back. So I haven't gotten to shave, shine, shower, shampoo.
you know, we'll get.
Are you going to let the kid out of the trunk after the podcast is over?
Yeah, he's in there. Sydney's having a ball. Sydney's playing with him and babysitting them, and they're watching TV. And so,
you know what, Danny, you said babies, and then which then triggered the thought about how babies are made. And we know, Danny, that babies are made with the sound of my voice. And like people will put this podcast on and it's like that, you know, babies are being made. And which then triggered the thought about Mark from Buffalo. And I don't have the picture up where I would show it, but Mark is dead sexy. Mark got a shirt from his family this year that actually says Mark from Buffalo, which I think sparks a trend. Like now Uncle Tony needs a shirt that says Uncle Tony. I don't know, like Jeff is a Chiefs fan from Kansas. I don't know if it's not Jeff from Kansas, because Jeff used to be a squadron commander. I just haven't figured out if we just want to refer to him as Top Gun Jeff or Jeff the Chiefs fan. Super nice fellow, by the way. He's the longest I've known. I've known Uncle Tony's the longest I've known in this role in my life, because I knew him from the Marine Corps. Jeff is one of the first people I met on the road at IBD when I went to Boston to go teach one year. And I've known Jeff I think it's over a decade now. Yeah, it's well over a decade now. So,
but that picture is classic. But if you live in Buffalo and you are in Buffalo and you see a guy walking around with a shirt that says Mark from Buffalo, just say, hey, stock nerd. You know, he's a stock nerd.
He's not lost. Like he's not looking at, like if you see him outside of Buffalo, like say you see Mark in Sheboygan and it says Mark from Buffalo, you don't have to return him to Buffalo. That's just the shirt that his wife got him or his family got him. And I'm telling you what, he looks good in it. And Mark, you better watch out, because Mrs. Mark from Buffalo, let me tell you something. Can't keep her hands off you on a New Year's Eve night. So you just don't wear the shirt tonight, man. Don't wear that shirt. It looks good in the shirt. So anyway, StockNerds, we love you. I can't believe we achieved 10,000 hours. We now know we got to make content more interesting, better value, even more value than what we did in 2020. We'll do that for 2021. But Danny, I've got, let's talk about, it's been a big year. Don, what's the S&P up this year, like right now? And then let's do the NASDAQ too.
Let's see. 15.5% on the S&P.
For the S&Ps. Okay. And I think the NASDAQ's up 44%. Is that right?
I track the NASDAQ 100, which is up 47%.
There you go, 47%. And so which leads to two thoughts. The first one being, there's a bunch of stock nerds that will contact us periodically, and they're saying they're waiting for the pullback to get in. And that kind of thought process is really tough. And I actually think you're going to get a pullback to the 21 here sooner rather than later. But how many opportunities in 2020 did you have to pull back to the mean, but you didn't take advantage of the opportunity to get in the stocks because you're waiting for this big horrific thing that never came? And then what takes up your time is complaining about what's going on in the markets, and meaning that this is hokum, for lack of a better phrase, that this is inflated by the Fed. Like you start complaining about Jay Powell, and all of this is completely nonsensical. And how many of you were waiting, and I've heard this actually recently, how many of you are waiting to get in until after the senatorial election in Georgia? Because I could throw the balance of power out in the Senate. And my point being here, the first point I want to make is there's always going to be something, right? Now that very well might be if depending upon which side or which senators are elected to the Senate, that very well could dictate how markets behave. I don't know, but it's not preventing me from participating. And that doesn't mean that you're just willy-nilly. It means you're participating based on the rules, things that we talk about in the videos. And there's 10,000 hours of videos that you've watched night in and night out, 5-6 nights a week. But what's going to happen is if there's going to come a point where you throw in the towel if you haven't participated, or you haven't participated enough in your mind, where you start performance chasing, and you're just looking for maybe stocks that are up. You think they're going to continue to go up, and they very well might. But a number of you are going to look to mutual funds to find who's outperforming. And the one of them getting a ton of press is the ARK funds run by Kathy Wood. And Kathy Wood's an interesting person, whereas she was the one coming out in the spring. The springtime, I believe, Don, is when I first heard this, where Kathy Wood was talking about Tesla 4000. I don't know if that was if that registered with you. What is the main fund ARK Ventures runs?
The ETF is ARK-K.
Yeah,
is the main one.
ETF is what I wanted to say. I said
they also have an ARK-G, which is genomics, and an ARK-W. Those are the three most popular.
Okay, so her performance, and look, this is from I think it's Ben Carlson. It's a blog he published right before Christmas, and it's super interesting. If you need a link to it, I am more than happy to share it with you. But I just need to read a little bit of this to you, and I want to discuss to you the economics of performance chasing and how it typically. I won't bury the lead here. It typically leads to a road to ruin, and maybe not in a way that you think. And before you say that you won't performance chase, everybody gets guilty of performance chasing, not in a grotesque way where ARK, when I get to tell you how much ARK is up this year, maybe you're like, well, should you stay out of ARK funds or any fund that's up tremendously? Or no, you just apply the rules, and we'll go over those here as we progress during the show. But let's see here. So Kathy Wood, her team runs ARK. ARK-K is the one that's up tremendously. So ARK has been outperforming for a number of years now, but as you can see, things have really ramped up. It goes on to this blog to say, investors have taken notice. Now listen to this fund, this inflow to the fund, and this is really key. So every time someone's buying ARK-K or ARK-G, you need to keep this in mind. Looks like ARK-K traded exactly $1 billion today, more than Netflix or Disney. ARK-G added another $880 million today. All told, ARK funds recorded $2.3 billion after a record $2 billion yesterday. Good chunk will convert to inflows, possibly looking at $600 to $800 million a day in new cash. Only Vanguard does more than that. So then if you think about those type of inflows, what does that do to the holdings of the stocks in those funds? Yeah, it drives them up, right? And so if we think about this,
or down,
or down,
if you look at what's gone on over the last week in these funds.
Yep. Mm-hmm. And so ARK is up 170% this year. Assets under management this year grew 900%. So take that in. And I'm going to ping Dan here because Dan's got some good stories about cash inflows and what happens. So investors, though, like you at home, or any investor, any individual investor, have a terrible track record when it comes to investing in very successful or hot ETFs or mutual funds the year after. And so I want to explore that with you, because this comes into the psychological aspect of investing. Because, well, clearly, the person who's managing ARK-K, could be any fund, could be any ETF, ARK-G, they know what they're doing, right? Well, investors go crazy for mutual funds, right? In general, total fund assets have grown tremendously, but let me see here. A mutual fund manager from the 60s, Joe Tsai, stood out from the crowd. After a run of underperformance that began in 1958, Tsai saw the number of shareholders in his fund sextuple, from 6K to 36K, from 60 to 61. After leaving Fidelity in the mid-60s to start his own fund, Tsai got crushed in the bear market of 68.70, which saw momentum stocks get killed. Assets fell 90% over the next few years, and Tsai's fund would go and have the worst 8-year track record over any mutual fund. So that kind of sets the stage. This guy, Joe Tsai, huge outperformance. And then it attracts a bunch of people, and then he loses 90% over the next couple of years. You don't know Joe Tsai probably, but you do know Peter Lynch. Danny, who's Peter Lynch?
He was a famous Fidelity
Buy what you know, right?
Fidelity Magellan.
Yep, he says buy what you know. Like that, he was one of the first people to tell people that publicly. Look at what your kids are doing. Buy what you know. Peter Lynch ruled the 80s, and for good reason. From the late 70s, when he took over Fidelity Magellan, through his retirement in 1991, Lynch returned 30% annually. Unfortunately, the majority of investors in the fund received far less than Lynch's 29% annual gains. It's been said the average investor in his fund earned just 7% per year, far less than the returns of the fund itself or the overall market, because they rushed in after performance was good and then redeemed or sold when the fund underperformed. By the tail end of the 90s, the biggest star fund manager was anyone at managing in a tech concentrated growth fund, as investors became enamored with these stocks, which then leads to this was one of Bill O'Neill's, any IBD follower probably knows this, Ken Hebner. Ken Hebner was, when I got to IBD, like there was a lot of Ken Hebner talk, okay? He was, still is a very smart individual in the markets, but CGM Focus Fund was it. Like it was the creme de la creme of the funds. And so Ken Hebner's Focus Fund was the best performing US stock market mutual fund from 2000 to 2009. He was named Morningstar's Fund Manager of the Decade for the aughts, or that time period as it's known. CGM was up more than 18% annually during a lost decade, which saw the S&P 500 close close to 1% per year. The problem is investors tended to add money after a huge year like 2007 when the fund was up 80% and pull their capital after it was down 48% like in 2008. That sell low, buy high strategy led to an average investor return of a loss of 11%. So Hebner's up 18% annually over this period, but the average investor lost 11% annually. The best performing fund of the decade saw its own investors, Danny, underperform the fund by nearly 30%. When asked what went wrong, Hebner replied, a huge amount of money came in right when the performance of the fund was at its peak. I don't know what to say about that. We don't have any control over what investors do. Following the dot-com flameout and 08 crash, investors became enamored with hedge fund strategies, and the whole thing consequently repeats itself. This continuous chasing and underperformance. And so stock nerds, I don't think, based on investor interactions I have with you, I don't actually think it's a bunch of stock nerds. I just think that if you're at a 401k or an IRA that offers these types of funds, and then you see like the Morningstar ratings, or you see the performance from last year, which they have to disclose, right? Last year, maybe 5-year, 10-year, 15, 20, since inception, and you see these big outperformance numbers, it's real easy to want to choose these funds. So a bunch of questions come to mind. One, Danny, what makes for the average investor? So when they say the average investor returned less, was a negative 11% for Ken Hebner's fund, and Ken Hebner's here returning 18% annually, what constitutes the calculation of average investor?
Well, it's not when the company buys the stock or the company invests, it's when you buy the fund. And the problem you have is you have people, like you said, performance chasers. They go in after a big uptrend, and then they get a pullback. They hit the pain threshold and they sell out. And the problem with the funds is they have to be fully invested at all times. And so they can't move to cash. They can't get defensive. So you're in it for the long haul, buy and hold. You just gotta take your licks. And behavioral finance people don't react like that. But case in point, and I've told the story before. In the 90s, there was a fund manager that I was, Art Bonnell Growth Fund. He was a darling of Wall Street. I interviewed him in January of 2000, I think. And at the break, at the interview, you know, he owned Dell Computer, AOL, all the good stocks, the Cisco Systems. At the end, we went to an interview. He said, "Danny, I don't know what I'm going to do. I just got $30 million of new money." I said, "Well, Art, that's a good problem to have because you understand. I got to go buy these stocks at this price. I can't sit in cash." And I was young in my career, and that's when I realized, wow, this guy just admitted to me that the prices were high, way extended, and he had to go add new money at the time when he's probably selling in his own portfolio because he knew it was so. As an investor, I hate to say this, but it's your job to know whether the market's good or not. And not only that, you have sector rotation. So within the fund, is it time to own that genre or that sector of a fund? If not,
Right.
you need to be out. Oh, there's very, very few mutual funds that will allow you where the manager can be unrestricted, where they can move to cash or go to bonds or go to stocks. Almost all mutual funds, they have a particular strategy or genre, small cap growth or emerging markets. And if it's not their time to shine, they're going to get creamed. So you got to decide, number one, overall arching question, are we in a primary uptrend? Is the market acting right? Then the next question is, which sectors, if the answer is yes, then which sectors are acting right? And then number three, which stocks within those sectors aren't too extended yet and are still a good buy?
Mm-hmm.
If the answer is no, we're in a downtrend, you probably want to sit in cash and wait till it changes. You want to look for inflection points. So timing is important. You hear these people say you can never time the market. That is not true, and we've actually demonstrated that.
Yeah, I think over 10,000 hours of videos watched this year has demonstrated that just fine. Don, what are your thoughts on this? Because I've got a couple, but I want to hear what Don has to say.
I found out the hard way a long time ago that when there's a sell-off in the market, it was because I had custodial accounts for my daughter for college, and they were in aggressive growth. I was in my 20s, and they lost a bunch in 2000, and then I got a tax bill that I had to pay for the gains that they had prior to the run-up that they then sold during the year 2000. So the worst thing that can happen is you not only lose money on the value of an aggressive growth fund in a bear market, then you get hit again if it's in a taxable account with the gains that they took that you didn't get because you could just be holding and never sold. Mm-hmm. And so you get hit the double whammy, the tax bill and the capital loss.
It's absolutely. And so I've been talking about this a bunch more, and this is what stops me from chasing. And now there are some stocks, look, I get it. There's some stocks that they're just pure momentum plays. And that's why there's just no absolutes when it comes often with life, but
that chart that you're showing right there mm-hmm. says a lot, especially what's happened those last 5 days. And it also is what's going on in our portfolios in-house. 11 trades this week, 1 buy, 10 sells. We're getting stopped out, or we're either getting stopped out or we're taking locking in profits on the way down from some things that peaked on that red candle reversal that you're showing last week.
A lot of the New Year's Eve day is oftentimes a down day in the market, and oftentimes you'll see market makers not supposed to do this, but they kind of just walk away from the bids, especially in a lot of beaten down names. Now,
this is supposed to be the Santa Claus rally, though, isn't it, Tim?
Well, that's sarcasm, right? Because I'm not good.
Well, at that. The ironic part is that the S&P is up 0.75% for the week, but let's look at the IBD's 50 ETF for the week. FFT that's down 1.4%. So very obvious selling in stocks that have made a big run. Maybe people are taking it off because they don't want to pay higher tax rates next year if that's what happens in the legislature.
Yeah, it could be anything. It could be just taking profits. Could be a bunch of you're allowed to take money out of your 401k IRA penalty free. You just got to pay the taxes on it. That's new due to COVID. A lot of things that could be happening, but this chart, it doesn't matter what chart you put up here. The one area where you won't get hurt and you won't performance chase, and even if you're wrong, you won't get burned. You might get singed. You won't get burned. It's with these ATR charts. And so when you're looking here, like I've got, let me adjust them real quick. Let me just do this. So when you're looking here,
daily?
it's a daily. It's a daily. So you can do weekly too. It's okay. It depends upon how you're managing your funds or your portfolio. So there's the mean here. Oh, excuse me. I just misplaced that. Here is the mean. No, I was right. There's 1, 2, and 3 is right there. And then down here is 1, 2, and 3. And so if you make 2021 the year that you buy stocks in and around the mean, you'll see a difference. And I'm not saying you'll see a difference for the good. Or you could, I mean, let's be honest, some of you are going to pick, you could buy the worst stock at the mean, and if it goes lower, Tim, you said you could buy any stock at the mean. No, what I'm saying is you can buy stocks at the mean and know very easily when you're wrong. And if you're wrong, you just stop yourself out. And if you're right, you just trail up a stop or say, you know what, I know that the move can go all the way up to the third ATR, trail up the stop, and when it gets there, simply going to sell. That could be a really easy buy and sell rule. And the probabilities increase dramatically when you get to that second ATR and that third ATR of a pullback. And it depends upon what kind of trader you are. If the daily charts are too much for you, and they are for some people, switch to the weeklies. You absolutely can switch to the weeklies. But what this represents here, to me, is your low risk entry point. And so, like, let's say you bought at the mean. Well, stop yourself out at the low here if you were to get there, and then just trail up your stop as you move along, and then you're not going to end up chasing. And what this represents, what these lines represent, there's so many new people that watch our videos. This mean is absolutely the 21 exponential moving average, and you can see over the last 21 days, FFTY moved 67 cents. But if we put in ARK-K, which, by the way, is a huge subject on Twitter and in blogs, that's why I brought it to your attention, of performance chasing talk. Well, okay, so here's ARK-K, and we're going to just lock it in there. It moves on a daily basis, $4.35 over 21 days, and you can see it's consolidating at the mean. So I don't know if ARK-K underperforms next year, and I'm not a big fan of making blanket statements. Is the fund going to go up 170% next year? I mean, I get you. Probabilities say probably not. But could it? Yeah, it's a market and anything can happen. But I don't have to concern myself. This is what I think happens to a lot of investors because it makes for great debate on CNBC. It makes for great debate on Bloomberg and especially on Twitter and blogs that, well, I'm going to invest in, Don, give me an underperforming group for 2020, just any group.
Underperforming group for 2020.
Yeah, I'm sorry.
I know what I'm in. I don't.
Yeah, let's look at XLU. Like, no one's talking about the great performance of XLU. Okay, at least I'm not. So here's XLU. That's what pops
XLU.
If you think of one while I'm talking, let me know, because the only one that popped in. Yeah, and so, well, I'm going to buy utilities because they underperformed this year, or I'm going to buy.
Or I want the dividend. Or I want the dividend.
Oh yeah, Don, give me a dividend ETF. Do you know one off the top of your head?
Yeah, VIG.
Let's do the VIG. VIG.
What's
So,
the
oh,
VIG?
that's actually, that doesn't look so bad. I thought it might be underperforming. Let's go back to XLU to make this point. And so just because something underperformed in 2020 doesn't mean it's time to shine in 2021.
SPLV is a low volatility ETF with supposedly a higher dividend.
Oh, there we go.
Anything that's not above that peak from February has lagged for the year.
Absolutely. So let's look at SLPV. So, well, I want to go
SPLV.
SPLV. Thank you.
Right.
So when we're looking at that chart, it doesn't look bad, but it's not outperforming. It's not above its peak, like Don said, which is an easy way to look at outperformance from that February peak up here. But just because this underperformed in 2020 doesn't mean it's time to shine as 2021. What you can easily do is take an ARK K, okay, and say, I'm not going to buy something. It doesn't matter what it is. It could be ARK K, it could be Tesla, it could be your stock du jour, Shopify. It doesn't matter. If it hits the third ATR, is that the place to initiate a new position? And I'm going to say no. And you, as a trader or investor, like, well, Tim, that is like $115, and it went all the way up to 140. You missed that gain. You can't touch all the waves when you go surfing. You'll increase your odds of success if you just wait and have a little patience. And yeah, you might have to buy it a little bit higher as it's consolidating here. And there's no guarantees. There's no guarantees in life. But I don't know if it goes up, and I don't know if it breaks down. But if you were to start a position, and everything we're doing here, StockNerds, as you know, is for your edification. If you need advice, want advice, seek advice. 855-732-5932 or dan@rivieraasset.com. But this is for study purposes only here. But if you started the position in this, and it doesn't even matter, let's just get the ticker symbol out of here. I would stop myself out there. And so you can start positions, and you can control the risk. Like, you can't control what happens in the Senate races come January 5. I can't. If the market's going to pull back on whatever result happens, I can't control that, but I can control the risk. So you can do position sizing. Maybe in 2021, you'll do 5 and 10% positions. Or if you're going to take bigger risk, you have to actually honor your stopping points. And then be confident to trail up a stop, or have a plan to take profits at maybe +2 ATR or 3 ATR. And you just want to develop a consistency game. That's all. And so, well, a lot of time, I mean, there are so many things that have outperformed in 2020. And I think it's really dangerous to say, well, it won't have that kind of year next year. Whatever it is, whether it's Tesla, Shopify, all those big gaining stocks, the assumptions are dangerous. Just like, look at Zoom. Zoom is not this. I mean, COVID has been more rampant, and yet this was the poster child for COVID, right, Don? Like, this was the stock you own for COVID because we're all doing Zoom meetings, and it's clearly not performing well. And so to have the assumptions that you're going to buy Zoom because COVID is worse, and there's a new strain, there's a new variant, so we need super Zoom because we got super COVID. Assumptions are really tough. And so that's why if you have a screening process that finds you what you believe are the top fundamental stocks based on your criteria, and Don and I do that, all four of us do that here. We quantify fundamentals based on certain characteristics of leadership. And then we apply technical analysis, is what I'm describing to you here. And, well, Tim, what would you look for in a stock? Well, I want to see a stock that's at the 21, that's at the mean, is what I want to see. I want to see a stock that is showing signs of life. Like, let's take a look here at Snap. Like, Snap's on my list here. Snap. I like Snap. And so do I want to initiate a position towards the third ATR, up all the way up here at like 53, 54? No, I want to be patient. And what do I do? I want to wait. I want to wait for a pullback to the 21. If that makes sense. I'm sorry I don't know if you guys could hear my phone, but my phone was speaking to me there, and I was like, gosh, I'm hearing voices. Didn't realize my phone was down to my right. So that I think can help you in 2021. But Don, let's do this. And Hunter, do you have any thoughts? Hunter, I apologize. I haven't really asked you what do you think about all of this? And you don't have to agree with me. The whole show is based on the premise that we're not a wind tunnel for each other's ideas. Like it.
No, I mean, I think there's certainly merit to what you're saying. I mean, the tough thing is you buy, ARKK today, and they're at their mean, or they're 21, but they have had a great year. And so, you're describing those investors earning much less than what the funds would claim to be their annual returns over the course of whatever time period. ARKK could drop 10, 20, 30% next year, but they're over a longer time period, their returns are still going to look pretty good, but that an investor that buys in today might be hurt. So, that's natural. I think of the majority of investors is, you want to buy something that's winning and that's hot, and then you get shaken out when they have a pullback. But one thing that I would say that I've learned and experienced over and over again, I've talked about this a little bit with Don, is for me, it's really easy to say I want to buy the pullback if it, like with Snap, but and something I've heard them talk about on IBD Live, something I've heard Don say a number of times. Sometimes just buying the weakness cannot work out for you. Sometimes it can, but I have gravitated towards Don's perspective of wanting to see buyers come in at those levels before necessarily pulling the trigger. Not that everybody has to do that, but sometimes they pull back to the 21 and they go straight through it. And then sometimes buyers step in and, like Snap is slightly green today. And so, that's a positive sign right there at the mean. So that would be my only comments, is just,
Sure.
and I've been learning, lesson after lesson after lesson through my research, through my own mistakes and successes, and my analysis with Don. And so I agree with everything that you guys have been talking about. And I'm not to get off on a tangent, but I'm thankful to be here and that I've been able to learn the way that I have over the last couple of months.
Well, I appreciate that. Don, any thoughts here?
Yeah, that Snap chart, I want to point to 3 days ago. Actually, 4 days ago, you can see the candle broke the 21 and then finished like right on it at the end of the day. And the next day, it's a little hard to see, but there's a big tail on the next day. Goldman Sachs upgraded it pre-market. It was up 10% at one point and closed near the lows of the day, and has now given up all of those gains, and it's still holding at the 21. Contrast that with Pinterest. I talked about this in the video last night about some of the signals that led me to start taking some money off the table with these two stocks. And look at the 6 sessions in a row. Now you had it right where you wanted it to be.
Oh, I'm sorry.
Zoom in a little bit. Yeah.
Sure. Oh, gosh darn it, Don. Let me just auto zoom this chart. And I apologize. Can you fellas still see my screens? I go to meetings once again. Okay, perfect. I can't see you guys, but
So
we're still
right now,
recording.
you've got like 4 huge candles.
Yeah, I'm fixing that. I messed up. There we go, Don. Where do you want me to go?
Yeah, that look at 6 days ago, that attempted breakout that failed on Pinterest. When something has been trending higher for a while and then goes sideways a little bit, see that about 15 candle consolidation where we went sideways before we attempted that breakout. And when you have a consolidation like this and the trend is up, the default should be that you're going to continue the direction of that trend, which would be a breakout. But the breakout failed. There's a Wall Street saying, from failed moves come fast moves in the opposite direction. So when that breakout failed, I took a little bit more off of Pinterest, and it's now broken the 21. And this is a case where, like Hunter said, sometimes just buying a pullback to the 21 doesn't work. It just blew through the 21 on Monday, tried to get back above it on Tuesday and couldn't, and now is trending lower, and the 21 has rolled over. When you can't get back up through the 21 after breaking it and the 21 starts rolling over, it's my most reliable sell signal to start taking some, if you haven't taken anything off the table, to do so. And then keep an eye on where the 50-day moving average is. In this case, it's only a couple of percent down. And this will be the first pullback of Pinterest to the 50-day moving average. If it doesn't hold there, I don't think the stock is worth owning anymore. Do I think Pinterest has a good long-term story? Absolutely. Am I going to sit through a big base because Pinterest has a good long-term story? I'm not. A weekly close below a 50-day moving average on something like this would get me out. So right now, just down to a stub position, which is 1.5 to 2%. And as long as it holds the 50-day, we'll hold on to that. If we get big volume coming in off the 50-day, it's a chance to add back to it at a very low risk entry point. And then if that fails, that's telling you everything you need to know about the stock.
And then you can
I'd like
even
to make a
do.
couple comments on what Don just
go ahead,
said.
I'm sorry.
I wanted to clarify. Okay. Number one, what Don also is saying is it's not all or nothing. So when Pinterest first started to break and start looking bad, he said some off the table. So he didn't sell the whole position, he sold a portion of it. Now he's saying if you break the 50-day, then the rest is gone. Now he said, you don't have to sit through a big base. In plain English, that means you don't have to sit through a big, painful sell-off and then wait possibly for months or even longer for that stock to come back to where you were. You can always get back in after it bases and then starts to move back up on strong volume.
Yeah, one of the O'Neill rules is in a bull market, leading stocks should hold the 50-day moving average on a pullback, and it's often a point to add more shares. If it breaks the 50-day, all bets are off then. So what should it do? Pinterest on its first test of the 50-day after 2 big gap ups should hold the 50-day. If it doesn't, don't argue with what the price action is happening.
So I like everything you're all saying there. And then the other way to simplify the rules too, if you could just even do 2 closes below the 21, get you out, is typically a shift in trend for me. 2 closes below the 21. And then
yeah, with a big leader like this, we had 100% gains on this. With a big leader like this, the 2 closes below made me set some on the failed breakout sold. 2 closes below got another piece of it out. So now we're down to the final stub piece of it and see what happens at the 50-day.
So it'll be interesting.
All of those are just rules. So if you at least have some rules, it's just not buying. It's just not hoping. You're not sure. Sometimes it'll reverse and move higher, and you missed out a little bit. But more often than not, you'll save yourself a lot of pain. And it's a more methodical way to do it. And over time, you're definitely going to have better results than just it being random.
Now I know some of the folks out there think that's a lot of minutia because it's a daily chart. But what does that look like on a weekly chart? Here is the weekly 8 period, which by the way, the 10 week is coming up to meet it. What if you start closing below this 8 week? Look at the difference between the 8 week here and all the way down here to the weekly mean, the pink line, the 21. That's a big gulf. So sometimes it does pay to pay attention. I know a lot of you want to invest and you want longer time frame charts out of us, but oftentimes when the gulf is that great on the weekly chart, it very much so behooves you to pay attention to the daily chart. Don, what else are you seeing? I know Danny's got a tight timeline today with baby news.
Something else I want to point out about the chart of pins.
Yeah.
And one of the O'Neill rules on a weekly chart, the 10-week chart should equate to the 50-day moving average. But in this case, when you have a stock that really has had a big run, leading stocks tend to close at their top of their range over the run. So when you're getting a 10-week moving average, it's going to be higher versus where the price of the stock is than the 50-day will be, because you're taking the last 10 high closes versus 50 closes that are not always at the high. So for this reason, pins has touched its 10-week and bounced right where it should. It hasn't hit the 50-day yet. So look at the weekly chart and the daily chart in situations like this. But the bottom line is, if you're going by the 10-week, 65.45 is the week for the low for the week. I've got a stop set below there because that will be a move below the 10-week moving average.
And so said another way, in that situation, the 10-week would be a more conservative or earlier higher stop loss to protect profits than the 50-day. It may come back further on the 50-day.
Yes, and it also would be a reason to pyramid sooner if it bounces at the 10-week with power and volume versus never even quite having gotten to the 50-day. So there's both situations come into play.
Real quickly here, Don, you seen anything else that you want to take into the new year that you want to bring to StockNerds' attention?
Yeah, just the big thing that I've been saying in videos is the last 6 days, 5 have been not good to growth stocks, and only yesterday has been beneficial to them. They're underperforming and we got to see if this continues. But again, we're not judging. We're letting the market take us out and lock in profits, both doing offensive selling and defensive selling. And like I said, this week only one buy, and that was Amazon, as it moved off of its 50-day moving average on some nice volume. Netflix is also another one that could have been bought. That's looking pretty good. But this week, money has flowed into the big cap tech stocks, but not into the leaders that have, semis, software, though retail, certain retail, though the groups that have led this bull move up have shown distribution over the last 6 trading days.
Absolutely, Hunter.
One more thing, you cannot assume that the leaders from the last uptrend or the last bull run are going to be the leaders this time. Some of them will be the leaders 4 or 5 or 6 times, or even for years.
Yeah, Tim's chart of Zoom is a perfect example of that when he showed that earlier. I mean, more people are using Zoom today than they were 6 months ago or 3 months ago, but Zoom topped, plain and simple. And this is another O'Neill rule. Fundamentals will lag. The selling will show up on the charts before it shows up in the fundamentals.
I want to pause you there, Don. You said something, as soon as you said the word Zoom topped, prior to that, you said more people are using Zoom right now than 6 months ago, than before. And that is a very true statement. And Zoom topped. And the first thought in my head, the very first thought when you put those sentences together, is it CROX or CROC? What is CROX?
X, yeah.
Oh, I had it. CROX. There we go. Let's get this on a weekly. So Crocs is, let's get it on a monthly. Well, let me see if I go back that far on this chart. No, I'm going to need a monthly. No, I didn't have it on a weekly. That's the problem. So Crocs. Now this is right when I was coming into IBD. More people were wearing Crocs at 75.21 than they were all the way back here. Crocs topped when it was at its most popular. And you're over a decade later and you're still not back to 75.21. And Crocs is one of the stocks of 2020.
Not just like the 3D printers. They were at their maximum peak after they sold off 70%.
But I think the 3D printers are a little bit different. Not everybody, it wasn't a popular consumer item.
Well, that's true. It wasn't more retail. It was more, commercial use.
Zoom is more popular now and known as a brand. Like Zoom is almost akin to Kleenex. You want a tissue, but some of you still say Kleenex, even though that's a brand name. You might, we're on GoToMeeting, but some people refer to it, hey, you guys are going to do a Zoom. Zoom is a generic term now.
Q-tip, like Q-tip.
Yeah, absolutely. And so this Crocs chart, man, was the first thing, Don, I thought of when you said more people are using it, never been more popular, and yet and look, we don't know if the book's been written on Zoom, but the chart gets you out of the ambiguity. The chart lets you know what the people that matter the most in terms of direction of price in stock, whether up or down, are thinking. And so there are a couple places on this chart. 2 closes below the 21. Don says should have found support at the 50-day. Okay, there you go. That's what should happen to leading stocks. You get 2 closes above, then an immediate gap down. That's a clear sign to you here. A clear sign that something ain't right. It can't get out of its own way. And now you have investors trapped. Look, you're going to, someone surely in our audience go, well, clearly hindsight trading. No, Don just described you the handling of pins. Like that's how you do it. And so that whole buy what you know.
A long time ago too. I mean,
yeah. And someone might, I get what you're saying. And someone might in our audience surely own Zoom from down here, right? Zoom is a 300. So if you have Zoom all the way up here, excuse me, pardon me for coughing. Zoom found support a couple days below here. but typically has found support in and around the 50-day repeatedly during its whole run. And now it can't. And now it's not finding support. It became resistance. That's a changing character. Your next level of it's got to hold is all the way down here at the 200-day around 308. So take that for what it's worth. The chart will tell you if a stock has potentially topped and whether this is the top for pins or not. I don't know, but you don't hear Don talking about more people using pins than ever before. I would argue that pins has never been more popular here. And so has it topped? It'll be interesting to see how that story develops. I just wanted to make that point. Hunter, I don't have much time and I apologize. I'm kind of hurting you here, buddy. Do you have any research, like something you've got to get out that you're like, man, StockNerds need to know that? I've got one last
No, well, and I can be really quick today. Just one that's pulled back in an area where leaders have shown weakness, and there's a lot that have either broken significant levels of support or their moving averages, and a handful that have pulled back right to them, and then one that's actually held up pretty well. Computer software enterprise. This group has Palantir, Shopify, Snow, Twilio, Net, just to name a few of some of the more recognizable names. Twilio and Shop look a little bit better than the other three. They're actually a little bit closer to their moving averages, but Snow's broken down a little bit. Palantir also is broken down a little bit. And Net has broken their 21, I believe, if I'm not mistaken. So if you look at this groups chart, it actually looks healthy from an industry group standpoint, but there's a ton of names in here. This is a very, very big industry group from IBD or MarketSmith standpoint. But a lot of and this is kind of indicative or representative of what Don said, where growth has been hit, it's underperformed, and a lot of the names in this space were some of the big leaders that had really big moves, and they've gotten hit pretty hard, and they've underperformed the last 5 or 6 days. So just something to put on people's radars. Maybe this is a buying point on some of these, maybe it's not, I don't know, but a lot of them have pulled back to their means or have broken significant levels of support. The other group is travel booking. It has actually held up really well compared to a lot of the other reopening plays, whether it's airlines or cruise lines, whatever. But pull up BKNG or EXPE if you don't mind.
No, there you go. That's what
and
I thought you were going to.
Both of those have actually looked a lot better than a lot of their, I guess, reopening peers, if you can even say that. But they actually have consolidated. They consolidated right around their 21 and held it nicely. And then both of these have had a little bit of a move up the last 3 days off of their 21. So just an area where there's maybe, I don't know if you'd call it abnormal strength, but compared to other similar type of plays and similar type of industries, even within this travel booking group, Booking.com and Expedia they look better than most of the rest. So just an area where there's been some strength.
Definitely relative strength there. One thing that's, and EXPE is on the 21 over 21 list. They also own VRBO, which is similar to Airbnb business model. No real volume has come into this over the last week and a half, and that might be because of the time of the year, or it just could be because the move's not going to be sustained. But that is the one thing that kept me from buying EXPE this week, was the lack of volume.
All right, Danny, let's do this. Give us the close, Danny, and then I got one last bonus thing, and we'll get StockNerds out of here on a holiday weekend.
Folks, listen, have a very happy new year and be safe. If you like what you heard, please tell a friend, tell a neighbor, just send them to revereasset.com. Tell them to hit our subscribe button, and they can put their email in, and we'll send them this podcast every weekend, and they will get our daily market insight video that Tim and Don do every night the market's open. And pretty soon we're going to add Hunter in the mix, and it'll be about 10 minutes of pure education and research and actionable ideas that you can look at. You can reach out to any of us if you've got any questions. You can email me at dan@revereasset.com, don@revereasset.com, Tim at Revere Asset, or Hunter at Revere Asset. We just made it really easy. You can also always call us old school at 855 Real Wealth.
All right, real quick, stock nerds and market lovers. Look, if you like, Hunter does a ton of good work. Interact with him. Absolutely email Hunter. He'll be more than happy to talk to you. He loves the Buffalo Bills. And then if you want brevity, you have a quick question. I can't even see your reaction, fella, so it's a bummer because my everything's frozen up on my side. Look, follow us on Twitter. Here's at TJ Razor. You can, if you follow us, we'll follow you back, and then we could become texting buddies. So at TJ Razor is my handle there. Danny is at one Danny Stewart, and you can see that like right here. Danny will absolutely follow you back. That was a great video, Danny. Where
the guy's cleaning his driveway off, snowing with a flamethrower.
Yeah,
you trying to make me cry with those pictures of Snickers? For those that don't know, Snickers.
Oh yeah.
Snickers passed away this week. It was not. It's been a weird week here.
Yeah. Very sad. And then Don is, let me get them more. One is it's D Vandenborg to follow Don. And so, look, Twitter's brevity for me. You can email me. I'm slow on email just simply because the questions get longer and my inbox fills up. I reckon maybe someone's better than that. But get a hold of us. Look, don't ever sit there and have questions. We're available for you. And you're not in some sales funnel. No, we don't have any salespeople. Like we're growing without salespeople, and I think that's a secret to our success as well. Netflix. I talked about Netflix. Netflix is off. Netflix is literally off like 10 points from its high here today, and it's had this move, and you can see it was trading below. But this is an interesting way to look at Netflix. So I got a daily chart here, and what I want to show you is the 4-day. And so I like daily charts, but I prefer longer time frame charts. And so this is a beautiful consolidation coming off a 4-day. And so what does that look like on an ATR chart where you don't buy you don't buy extended off? It's the same rules, but like here is the mean, and you can see Netflix just trading, a little bit below, a little bit above, really not doing anything. And now it's got this beautiful consolidation here, one ATR, but it's a 4-day chart. We'll see. I think Netflix is going to come up and look at this 575 area, and then that third ATR. It doesn't have to do this. Like the market doesn't have to do anything, but that third ATR is up near 600. That second ATR is up by 562. So I think if 575 happens, you're gonna come up here close to 600. And earnings are the third week. Netflix typically kicks off big tech FANG earnings third week of January on 1/19. So look, stock nerds and market lovers, hopefully that all helps. Danny, take us home with a better close than what I could do.
Folks, listen, Happy New Year and a good New Year's resolution, rules over random investing. We'll talk to you next year on Your Money.